Good afternoon, ladies and gentlemen. Thank you for coming this afternoon. I know it's been a long haul for those of you that have been here since 8:30 a.m. So thank you if you have been here that long. And I hope the sandwiches were not too bad, because we always compare them in every city. So thank you. I'm Louise Walsh. I'm the CEO of the Future Generation Investment Companies, FGX and FGG. Joining me this afternoon to do the 1 hour presentation is firstly Jeff Wilson, the founder and creator of the Future Generation Companies, as well as a board director of both companies, the chairman of the investment committee of FGX, and also he's on the investment committee of FGG. Next to Jeff, we have Justin Breitling, and he's from Watermark. He is one of our much valued, and we thank him sincerely, fund managers for FGX. Next to Justin, we have Frank Casarotti, and Frank is the head of distribution at Magellan. He's also a board member of FGG, and Magellan is one of our FGG fund managers. Next to Frank, we have Jane Shelton, and Jane is the New South Wales manager for Mirabel Foundation, which is one of our much loved FGX charities. And last but not least is Bridie O'Day, and she's from the Black Dog Institute, based out of the University of New South Wales, and she represents one of our FGG charities, Black Dog. So basically, Jeff and I will do an update presentation for about 15 to 20 minutes. I'll then do a short panel discussion with the three fund managers, Jeff being included as one of those, and then we'll have a short discussion with the two charities, and then we'll open up for questions. Justin's just told me he's got to pick his kids up and he's got to leave right on 3 p.m. So the good news is we'll try and get you away right on 3. So thank you very much for coming here. A short disclaimer, so I'm sure you've read it by now. But basically, for those of you that are not shareholders in one or both companies, just a very short recap on the purpose of the two companies. So the Future Generation Investment Companies exist to provide investors with, of course, an investment return, but also a social return. They're very much examples of impact investing. And if you're not so familiar with that term, it's very much on the rise here in Australia, but also globally. Now, the companies are very much a win for shareholders, for the charities that are recipients, and certainly for the fund managers as well. So these companies exist and are an absolute win for shareholders because they provide investors with exposure to the best boutique Australian and global fund managers without investors paying management and performance fees. So that's really the essence of what we're talking about here. And by not paying those fees, it enables us to donate 1% of our assets of both companies to charity each year. So just to give an example, with FGG, which is the global equities company, so that was listed in September 15, in that case, if you were investing with one or more of the managers, you'd typically be paying a 16% performance fee and on average a 1.3% management fee. So here, you're not paying any performance fee, and instead of paying the 1.3% management fee, 1% of the assets in the case of both companies, are actually paid to charity. So FGX is focused on children and youth at risk charities, and FGG is focused on children and youth mental health. The charities are very much the winners in this scenario as well, because it provides them with an ongoing stream of annual donations. As long as they're one of our recipient donations, then they have to perform. I mean, they have to meet key performance indicators that we've set with each of them each year, and they're measured against those, because we want to be able to measure the impact of the work that these charities are doing so that we can make sure that you're aware of it as shareholders. Lastly, from the fund manager's point of view, it does provide them with a unique opportunity to contribute to Australia's future generations. And the fund managers, we absolutely can't thank enough for their contribution here, because we wouldn't be here today if the fund managers hadn't agreed to waive their normal management and performance fees. So we especially thank Justin and Frank and the other 28 fund managers that we have on board with us. Today, we have gross assets combined for both companies of at least about $750 million worth. We started with $200 million when FGX was listed in September 14. The plan is to substantially grow these vehicles so that within 10 years, the gross assets will be at least $3 billion. So that means that the annual donation will be at least $30 million a year. So we're aiming to be the second biggest funder of the non-profit sector within 10 years, second only probably to the Paul Ramsay Foundation. And many of you will be familiar that Paul Ramsay left that $3 billion bequest to charity when he died about three years ago. The investment objectives are threefold: to provide a stream of fully franked dividends, secondly, to achieve capital growth, and thirdly, to preserve shareholder capital. Now, if we take a look first at some highlights for FGX, so Future Generation Investment Company, and as I said, this vehicle is for investors that are interested in investing in Australian equities, and it was the first company that was set up in September 14. These are the 19 fund managers that are supporting FGX. These are all some of the best performing boutique managers that the investment committee could find, and here in Australia. And we're delighted that Watermark is one of those, and you're going to hear a little bit more from Justin very shortly. Jeff will talk just straight after me a little bit about the performance and what the investment committee's been up to for FGX as well as FGG. We also want to acknowledge the non-profits or charities that we're supporting here. So this is where the 1% is being directed of the assets. Most of these non-profits operate nationally. Some of them only will operate on the eastern seaboard. You're going to obviously hear from Jane very shortly from Mirabel, and they operate most of their work in New South Wales and Victoria at this point in time. These charities are under a lot of scrutiny. We're quite demanding with what we want them to achieve, and at some point in time they all know, they may not necessarily get ongoing funding, but we would like to do that, and we'd like that to increase each year. These are our much-loved service providers. So these are the businesses that are acting pro bono in most cases behind the scenes to make these companies work and to keep our costs as low as possible. Just so you know, I'm actually the only paid employee of both companies. So my package is split three ways. A third is paid by FGX, a third by FGG, and WAM actually pays the other third. Mertons do our company secretary work, pro bono. Wilson Asset Management behind the scenes is incredibly generous. Just so you know, we have a full-time finance person that sits in the WAM finance team that purely works on the finances for both of these companies, and their salary is fully funded by WAM. So I can't thank Jeff, Kate and Chris and the team at WAM enough for the work that they've done to support these companies to date, but also in the future. Just a few highlights of the 6 months to 30 June 2017. Firstly, a 2.2 cents fully franked dividend that was paid in October. Annualised 4.4 cents for the financial year 2017, and that was a record dividend of 2.2 cents paid in October. The charitable donation for FGX that was paid last month, $3.8 million. So that keeps on rising each year. And if you compare that to the $6.4 million worth of savings that is foregone management and performance fees from the fund managers, but also the service providers, it's well and truly above the donation of $3.8 million, which we're obviously very happy about. Some of the impact of the charitable work, I won't dwell on this too much because we're going to actually hear from Jane and the incredible work that Maribel does. But we provide this information to all of our shareholders every August so that you can actually contribute and have a say in where that 1% donation goes each year. So this is sort of the summary of some of that work. If we take a quick look at FGG now, so this is Future Generation Global Investment Company, and many of you will know that once FGX was listed in 2014, a lot of investors said to Jeff, would you be prepared to do a global equities equivalent LIC? And so that's because we're underweight in global equities, and that's really why FGG was created, and we were successful in raising over $300 million during the IPO in mid-2015, and it was listed in September 15. So we again want to thank our fabulously generous fund managers in FGG. We have 13 fund managers in FGG, including, of course, Magellan, who I mentioned earlier. These guys are incredibly generous in waiving those fees, and we like to thank them as much as we can, because we wouldn't be here up on stage if it wasn't, there just wouldn't be FGX and FGG. Jeff will talk a little bit more about the performance and what's been happening with some of the fund managers and movement there. We recently added Caledonia as a fund manager to FGG, and we're very keen on adding them. We've wanted to have them in as an FGG fund manager since inception, so we were delighted that 2 years on they agreed to come on board and to invest, and we've got some money invested with them. The charities, the FGG charities or non-profits, these are the 8 that we've carefully selected in the children and youth mental health space. These all operate nationally. Probably at least half of them are headquartered here in Sydney, and the other half are headquartered here in Melbourne. We're going to obviously hear from Bridie at Black Dog, but I wanted to just mention Butterfly Foundation for Eating Disorders, because we actually fund the first ever youth intensive patients program for young people with eating disorders. It was launched by Butterfly in July this year. We all went along to the launch, and this program is a first outside of the USA. Prior to this being launched, if you had a child who had a severe eating disorder, the best treatment was in Los Angeles, and it would cost a family over $100,000 to be treated in that program. Here, what we're doing through the funding and the subsidies that we're providing, it means that families can have a child enter that program for only hundreds of dollars. And the plan is, assuming that pilot works, is to build that out so that it happens in other locations around the country, as well as a residential program. But last month we actually got a comment on our Facebook page, which I might just quote. "Well done, Future Generation, for your contributions to the mental health sector. Mental health issues are often the invisible illness of society that doesn't attract funding, as people do not understand the issues. An eating disorder has had a devastating impact on my daughter and our family. Thankfully, after 3 years in hospitals, she has put her life back together and is now training to work with youth in need. Early intervention is essential and should be available for all states in Australia. Thank you for seeing the need and making the difference." So we feel pretty good that we're really doing something substantial in that eating disorder space. The service providers, I won't dwell on this too long because they're a very similar list of businesses and firms that are supporting us behind the scenes. There's a couple of extra ones with FGG, but I would mention even the ASX is actually waiving the annual listing fees for FGX and FGG. They don't want the acknowledgement, but we're really the only 2 companies listed in Australia that happens with, and as far as we know globally as well. So we're incredibly grateful to those service providers. And just a few highlights again for the 6 months to 30 June. The donation that we made last month was $3 million to youth and mental health charities, which we were delighted about. And alongside that, compare that with the $4 million worth of savings that have come from foregone management and performance fees, and also fees that the service providers would have normally provided. So again, it well and truly outweighs that, as well as a 1 cent per share fully franked dividend for FGG. So just a little bit on the impact. I probably won't say too much here because I've mentioned the Butterfly Foundation impact, and obviously we're going to hear from Black Dog. But before I hand over to Jeff to update you on the performance of both companies, I just want to quote you. It was interesting on Melbourne Cup Day. An article was published on Livewire by Daryl Wilson, and it was headed, "If 24 licks ran the Melbourne Cup, which would be our favourite?" And I just quote here, he said, "If ever there was a lick designed to win this race, FGX and its stablemate FGG are them. They can race under all track conditions. They will stay the distance. These two thoroughbreds are race favourites without a doubt," and they were in his top 3 licks in Australia. He also said 6 months earlier in a different article about FGG that it was his desert island stock. So if he could only invest in one stock and he lived on a desert island for the next 10 years, it would be FGX. So thank you, and I now call upon Jeff.
Thanks, Louise. Now I'll just talk a little bit about the fund managers, the investment committee, how we've put together the portfolios, and just why fund managers stay in the portfolios and why they come out of the portfolios. I'll just take you through here, just starting probably at the investment committee level. What the investment committee is trying to do is pick a group of fund managers that can provide a return to shareholders in line, if not excess of the market, with less volatility than the market. So broadly, what the investment committee is trying to do when it's working out which fund managers, how much each of the fund managers should manage, what they're trying to do is give shareholders a return. Say the market does this over time, give the shareholders a return, less volatility, but if not the market performance, if not better. And this is FGX. I'll do FGX and I'll do FGG. That's broadly how the investment committee has split the pie, which is broadly half of the money is to managers that are along the market, and that's a manager that pretty much has nearly 90 to 100% of his money in the market. And what he's trying to do is perform the best he can, beat the market index. And then the other part of the other half of the pie, effectively, they are managers that are more absolute in nature, a combination of the managers that are absolute in nature and the market neutral managers. And we fit in, as in Wilson Asset Management, we fit into the absolute category where we can short if we want to. It's never a big percentage of our portfolio, but we can dial up our cash levels if we think if we're worried about the market. And currently we've got a little over 20% in cash, and our cash levels have been as high as 70%, and we have been fully invested. And then you've got in that other 50% is the market neutral managers, and that's where Justin comes in at Watermark, where what they're doing is their expertise is adding value and they're taking very little market risk. So effectively, the market neutral managers, you're starting with $100 million. They put that $100 million in the bank and get a return, and then with the $100 million, they buy $100 million worth of stock, and then they short $100 million worth of stock. So you're taking very little market risk. And obviously, if the stocks they buy go up and if the shorts go down, you're taking very little market risk and you're making a good return. Obviously, if they go the other way, then you're taking double the risk. But that's broadly how the investment committee have put together the funds. And in terms of just both FGX and FGG, there's a lot of discussion about active managers versus passive managers. And there's a great article that Tony Boyd wrote in Chanticleer a couple of months ago. And it was looking at boutique asset managers versus everyone else. And I think what people get caught up with is there's the passive money that just gives you a return of the index, and there's a lot of the active money which is managed by big institutions. And what they're trying to do is what they're trying to do is grow their funds under management, so they don't want to be too far away from everyone else. And then you've got another pool of capital in those active managers, which, say, Watermark is, and Magellan is, and ourselves is the boutique managers, where the founder's involved in the business. There's a lot more emotion and passion, and all the studies show the boutique managers outperform the other categories over various periods of time. And so what both investment committees have done is they've found the best boutique managers for Australian equities and global equities. And that's the logic behind it. If we just go back, I'll take you back to the portfolio performance. You see the top line is the FGX investment portfolio. I want to take you to the far right-hand side. See the heading there, standard deviation since inception. The standard deviation is effectively the measure of volatility of the portfolio or index, and it's a definition in our investment world of effectively risk you're taking. So you'd assume the lower risk you're taking, the lower volatility, the lower standard deviation, the lower return. And here on the far right-hand side, you'll see the investment portfolio of FGX, a very, very low volatility, 6.8%. If you go down a bit further, the All Odds Accum index, that's 11.7% volatility. That's over the last 3 and a bit years since FGX has been operating from September 2014. And if you had the index below, if you had the small ordinaries, obviously smaller companies, higher risk, higher volatility, then you'd probably have a figure of 13 or 14% down there. So the portfolio from a volatility perspective or risk perspective has delivered exactly what the investment committee wanted. And in terms of, with that 6.8% volatility, then you'd assume the returns will be less than the market, because that's nearly half the volatility of the market. So you'd assume you should get about half the return of the market. The market delivered since inception 6.6%, but the portfolio managers, the boutique managers that were selected by the investment committee, delivered 9.7%. So it actually delivered probably nearly 4 or 5% more than what was expected. And to me, that is pure alpha. And so the investment committee, the fund managers had really all done an exceptional job over that period of time. If we just flip over, FGX, Louise mentioned about the dividend, the last dividend of 2.2 cents. And there's around about 5 cents in the profit reserve, a little over 5 cents in the profit reserve, so a little over that. So the next year's dividend is well in train of at least that level, if not maybe just a little bit more. But the other part of the return is, what are the assets worth? So the NTA, the pre-tax NTA, far left-hand side, $1.19.15, and the share price, FGX at the moment is trading around $1.14. So the shares are cheap in terms of trading below the assets. So they're 5 cents cheap. But actually, that was the asset backing at the end of last month, and we all know the market's been up this month, so you'd assume the asset backing is a sprinkle higher than that. And if we go back, they are the individual managers. And and that's how the fund has been allocated. We won't allocate, the investment committee of both funds really made a decision that we won't allocate more than 10% to any one manager on initial investment. And the reason why someone might have more than 10% is because they've outperformed the other managers. So that's the logic about that was, so we had quite a diverse group of managers. And in terms of putting managers in and out, and this is the same for FGX and FGG, both investment committees, you've got to remember we've selected these managers to provide a risk-adjusted return. So if the manager, what are red flags for the investment committee to start reviewing closely the managers? Obviously, the investment committee looks at the performance numbers on a monthly basis. We also have a quarterly survey that we do with all the fund managers. They have to fill out, and we have quarterly meetings, the investment committee. But it's very dynamic. And what we do is, if a manager is performing better than we anticipate, then we review them, because normally there's the sort of the what's that bias? Confirmation bias. You think, oh, how smart are we as an investment committee? We selected this guy and he's doing a lot better, but is he taking more risk than we anticipated? So we need to understand why they're doing better than we anticipated. And then also on the other side, we all, obviously if someone's performing, is underperforming, then we need to understand why. And the other red flags are any change in personnel. And with FGX, we've added a few managers. We've removed one manager for underperformance. It was a quant fund. They actually had some unexplained performance, which we queried them on. They explained that they've put another filter in, and it won't happen again. And then unfortunately, there was some unexplained performance. So then we removed them. In terms of FGG, again, if we look in the far right-hand side, I'll go a bit further. We'll go to the asset allocation. So broadly, again, trying to get 50% to quant absolute, and the other 50% long equities. We're a little bit longer the market in terms of more direct exposure to the market, and I'll come back to that in a second. At the investment committee level, not at the individual fund manager's performance level, but at the investment committee level, we made an error at the start, when we put the first group of fund managers together, because we added some fund managers that were purely Asian fund managers. So what we ended up doing, even though we put all the managers through an optimiser, and that's broadly to get exposure to the world, as it is in the MSCI Global Index, broadly 50% US equities. We ended up having too much exposure to Asia. And what we've done after the first period of time, we decided we wanted to remove that sort of over-allocation to Asia, and just go to the same managers, but just their global fund, and let them decide on the individual allocation to Asia. And what that over-exposure to Asia in those early days did, of course, increases your volatility, because Asia is a lot higher risk than the more developed economies. So that's broadly, and the last Asian fund will be coming out in the next couple of months, and that'll give us about another 3% in cash. And that, with the excess cash, we're going to add to a more absolute bias or market neutral manager in FGG. And with Caledonia, I know Louise mentioned that they've come on recently. When we first approached them, they said, hey, look, we've got our own foundation, and we give a lot of money to charities directly, and we think it makes sense for us to do our charitable work through that. and to me, take my hat off to them. And it was really the great work of our chair, Belinda Hutchinson, who's persuaded them to be involved. So, that, to me, that was having them on board was fantastic. In terms of FGG, the NTA, just a little on the far left-hand side, just under $1.21. And the good news or the bad news is today they're trading around that price. So they're trading around NTA. So that's, you could argue that's fair value. I could give you an argument to say it's not fair value, it's cheap, which I will in a second. And actually, I'll give you that argument now, I may as well. FGX1's easy because that's just trading below NTA. But the question is, the theory on listed investment companies is, the theory is listed investment companies per se trade at a discount to NTA. Now, why do they trade at a discount to NTA? Is because assuming the average listed investment company performs in line with the market, and most of the listed investment companies, or the newer ones, the ones that have been created over the last 3 decades, are externally managed. And so say you pay an average of 1% management fee. So in theory, the discount should be the net present value of that 1% management fee over time. So whether they should trade at a 5 to 10% discount, that's the theory. The interesting thing is, with FGX and FGG, I know you still, effectively the 1% goes to charity, but you're actually, as an investor, you're getting a free kick. And Louise sort of pointed it out quite clearly. Look at FGX. The managers were entitled to performance fees over the last 12 months. They had rebated it back to the company, and there was the 1% costs over the 12 months was $3.8 million, but the managers gave back $6.4 million. So the difference between the 3.8 and the 6.4, that $2.6 million, shareholders got that. So, but if you had invested in those managers' funds, as we had, you would have paid $6.4 million, but you only paid 3.8. So you're actually getting a 40% discount to get exposure to those managers. So you could argue, you could do an NPV of the savings you get. And so, you could argue that you actually should pay a premium to NTA because of the discounted benefit you're getting to get exposure to those managers, paying less than what you normally would. Anyway, that's all theory. But get back to that's my story. Now that no one's trading at NTA, now we've got to lift the bar a bit higher. But looking at this, let's look at the far right-hand side and let's look at the standard deviation. And it's interesting, you see there the standard deviation of the fund was 8.9% and the MSCI Global Index was 9.9. Now, I would say our overexposure to Asia probably added at least 1% to the standard deviation over that time. So even though it was less volatility, less risk, but it was still higher than what the investment committee wanted. But we're very happy with how the portfolio is positioned now. And then the performance, there was the Asian lag, which impacted us in the early years, but you see the most recent performance is pretty much in line, and we'd assume that over time, all the managers selected have outperformed over time, and that'll play through. So that's pretty much, and that's the asset allocation. As I said, we'll be moving out of the Antipodes Asian Fund down the bottom, and part of that money will go into the Antipodes Global Fund, so they'll make the asset allocation at the global level. With the managers there, we have removed a manager for personnel changes, we removed a manager for underperformance, and we've removed another, I think there were 3 or 4 managers that had direct Asian exposure, which we've taken out of the mix. Now I'll hand you back to Louise. Thanks.
Thank you very much, Jeff, and we absolutely thank you as well. So creating these two vehicles. So now I'm going to do a short panel session with the fund managers. So the first question, gentlemen, is can you give us your view on the market? And I'll start with Justin. Thanks, Justin.
Thanks for that, Louise. It's everyone's trying to guess where these markets head and how long this cycle will last. My sense of it is the advance we're seeing in shares will probably continue for a little while longer, and that's because today the global economy has a head of steam. You've got synchronised growth across most of the major economies, and you've got the support of ongoing policy support from central banks with very low policy rates. It looks like this tax package, which is before the US Congress, will get passed, and the US market actually hasn't, if you actually look at the companies that benefit from that tax relief, they haven't really outperformed. So the market hasn't really absorbed that information yet, the fiscal support that looks like it's going to come through. So, and it's very positive for profit growth in the US, for the corporates obviously that benefit from those tax cuts, but also American households that benefit from the cut in the tax rate. So that's a very big dollop of stimulus, which is going to be put on top of an economy that's performing very well and accelerating. There's lots of momentum in the global economy, and that's going to be supported further by this fiscal support. Having said that, financial conditions globally are starting to tighten. Policymakers are starting to tighten the screws. They're raising interest rates. They're withdrawing their quantitative easing programs. And so, what happens eventually? Eventually, these product, labour and goods markets will tighten. And the thing you've all got to watch is inflation. And so the reason we're where we are today, the reason interest rates are still so low, even though growth is quite strong, and unemployment rates are at record lows in most major economies, is because there's no sign of inflation. So just keep your eye on inflation. As soon as you start to see a little bit of inflation, then those interest rates will jack up quite quickly, and that'll happen here in Australia as well. It will happen. It might be a year away, but at some stage in the next year or two, financial conditions will tighten. The growth in these economies will naturally peter out, and they'll roll over, and we'll move into the next down cycle. So that would be my best guess,
Right.
Louise.
Thanks very much, Justin. And how about you, Frank?
Yes, so from a global perspective, the challenge for us is to really filter the noise and really focus on things that do matter. So, there is lots of noise out there, whether it's terrorism related, whether it's Syria related, you name it. The single biggest influence that we're keeping an eye on, and Justin alluded to this, is the movement of interest rates. We've basically seen central banks through quantitative easing basically distort markets, distort market valuations, and our view is that yes, the next phase of interest rates is likely to be up. The real challenge is to look beyond the near-term direction of interest rates, because we're probably of the view that they will moderate after that. So yes, inflation could well kick in over the near term, but we think that technology advancements and other influences will see interest rates potentially moderate lower after the near-term rise. Obviously, other geopolitical related issues, obviously what happens on the North Korean peninsula is potentially frightening. If someone makes a mistake in their calculations, then kind of all bets are off. With Trump, we've basically taken the House view that whenever he speaks, we put the earplugs in, because it's got absolutely nothing to do with what he says. It's what he gets through Congress and the policies that he actually introduces, as distinct from those that he's talking about. To the north, obviously, China is critical, and we continue to watch their financial statistics if you believe them, then that's definitely worth the watch from our perspective. Yeah.
Thank you. Thanks, Frank. And Jeff?
Yeah, thanks, Louise. I'm not quite bearish. I'm probably more, well, like I suppose both of you. My view is, it's the third longest bull market in the US ever. We're in the mature stage of the bull market. We're close to the end. Just be conservative.
Great, thank you. Good summary there. Okay, and this is probably my favourite question of the afternoon. It's the question where we ask our fund managers for a stock pick or two. So I might start with you, Justin, with your one or two picks.
Well, I might have to give you three.
When have you got to leave? When have you got to leave?
That's a result.
So I'll give you the three names, but maybe just talk to two of them.
Okay.
I couldn't decide between the three. But three larger Australian companies that I think are of interest to many of you and have probably touched you, or would touch most of you in your daily lives. The first one is NAB, National Australia Bank, the old National Australia Bank. The shares have fallen sharply following their result last month. The result itself was actually quite solid. The business is performing quite well, but there was a lot of misinformation around their guidance with their cost structure. So they're talking about their costs going up quite sharply this year, and then they're going to hold their costs flat for a number of years, and then they guided towards a cost-to-income ratio which actually frankly looked unachievable in the medium term. But if they could ever get there, it would be spectacular. But everyone was scratching their heads, trying to work out how they could get there. So it looked like very ambitious guidance. The market took it very badly, and the shares sold off sharply. They're down 10% since the result last month. The business, it's a great business. They have a very strong position in the business banking market here in Australia. Small, medium enterprises and middle markets, that's their stronghold. The banks are out of favour at the moment. Westpac, ANZ, NAB, there's obviously talk of a banking inquiry. So they're really out of favour. The banking inquiry will probably come, the Royal Commission, but the banks are incredibly resilient. They will navigate through this challenge, and today they are relatively cheap in a very expensive market. So that's NAB. The other one, another company you'd be very familiar with, Woolworths. We actually don't mind Woolworths here. They're out trading Coles, by a healthy margin. In the last quarter, their what they call comp store growth, or the growth of their average store, was growing twice as fast as Coles. They really have turned the tables versus Coles. Coles stole the march on them a few years ago, but Woolworths have fought back. They've changed their messaging. They cut their prices. They put over $1 billion into the basket in terms of cutting price. They've changed all their marketing, and they're really getting customers back into their stores. They're trading well and trading much better than Coles. In the latest market share data, it looks like they're even holding off Aldi, which is quite an accomplishment. So they're taking share from Coles, and Aldi aren't actually growing their comp stores sales in the last, it doesn't look like they are at least. And the feedback from suppliers is still very positive on Woolworths. There's very good momentum there. They're losing a lot of money in Big W, but if you add those losses back, then the shares are on 15 times 2019 for a business that'll grow double digits in the next 2 to 3 years. So I think that's very interesting as well. I'll just leave you with a third one. I won't go through the story in detail, but Ramsay Health Care, the largest private hospital operator in Australia. The shares have suffered more recently because of the concerns around private health insurance. A lot of the younger people are opting out of the pool, but both sides of government are committed to private health insurance. It keeps those people out of the public hospital system. And Ramsay is an outstanding operator, and as Louise mentioned, also one of the biggest contributors to the charity sector. So 3 interesting names for you to consider.
Great. Thank you very much, Justin. That was great. So Frank.
So I just want to give a quick flavour of the portfolio, and just quickly to talk about our top 10 holdings. So Alphabet, which owns Google, Apple is in the portfolio, eBay, Facebook, Kraft Heinz is in the portfolio, Microsoft, Starbucks, who make the world's worst coffee, Visa and Wells Fargo. Wells is like the Commonwealth Bank of America, if you like. But our single biggest holding is in a company that is known to everyone, hopefully in this room, is Apple. And if ever there was a case for active management, Apple is arguably one of the most analysed companies in the world. All the analysts are all over it, tracking every single transaction and every movement. Their handset sales, iPhone sales, came off their peak. I think they were growing at about 17% year on year. They dropped to about 15% and the stock was sold to below $100. This is about 14, 15 months ago. At that point, and we'd followed the business quite intensely, but had never bought. But when it hit sub $100, we thought this is a fantastic buying opportunity because we got our heads around the fact that it wasn't about the handset sales, it was about the ecosystem. And what Steve Jobs did was basically build this beautiful walled garden and invite us all into his walled garden and then slam the door behind us. We're trapped in his ecosystem, okay? And what we think is about Apple is more of a subscription service than a handset seller. And you look at their loyalty, their customer loyalty, it's off the Richter scale. It's something in the order of 95, 99% propensity to repurchase. So if ever there was a global product that is really just penetrated our complete lifestyle, then it's Apple. That share price today is around $170. Okay, so the good old passive investors, they would have held index weight. The active investors said, "Oh my God, this is a gift from above," and would have loaded up. So that's our best exposure.
And I must say, I'm one of those Apple obsessed people,
Yep.
and I will always be, I think, 'cause I don't know if anything's going to outdo that, but we'll wait and see. Jeff?
Hey, thanks, Louise. And so you've got some really high quality Australian companies. You've got high quality global companies. Now, I'm giving you risk. I'm giving you really small companies that you might lose a lot of money on or make money on. And probably one of the first one's the riskiest, and then the second one's got leverage. The first one is Emeco. You know, it's mining services. Effectively, mining services. Well, the industry was a number of companies going under. 3 or 4 years ago, it's come back, and we just think it's in the process of recapitalising. We are shareholders, and with this last recapitalisation, we think there's an even money chance you make 30 to 50% on your money. But it is high risk. And the other one probably comes into the same category. I'm giving you double leverage, because I'm selecting an owner of fund managers, Pacific Current. It's just got new management. Tony Robertson, very impressive guy. He was at OAMPS, really straightened that out before Wesfarmers took it over. And it's trading on a P of about 15 times, and it did own a stake in. Owns a stake in a number of fund managers, but it did own a stake in Investors Mutual, sold out recently, and the market marked that back for that. Trading on 15 times, we think it could easily trade closer to 20 times. But again, if the market does fall, you've got double leverage there, because you've got a fund manager, so it impacts that. So that's probably the more risky part of your portfolio.
And listen, thank you very much, Jeff. And look, up on the screen you can see that we're advertising our second ever investment forum tomorrow afternoon, 1:30 till 3 in Melbourne at the Convention Centre. Now, I'm hoping some of you were here in May when we held our first ever investment forum, where we had 12 of our best performing fund managers with one stock pick each, and they each gave a 5-minute presentation. Now, I'm guessing it'll be tough for you to get to Melbourne tomorrow, but we are live streaming it, and we've got 11 of our best performing fund managers. We have over 900 people registered. It'll be the biggest event that WAM or FutureGen has ever done, and Jeff will be up on the stage with his stock pick. And
it wasn't one of those two.
Wasn't one of those two, exactly. I'm intrigued to see what he's got in store, but also colleagues of Justin and Frank from Watermark and Magellan will be presenting their best stock pick as well. So we're really looking forward to that, and make sure that you do register for the live stream. We'll be back here on the 15th of May next year doing the next investment forum here again. So now I'd like to change tact and talk to our two recipient charities or non-profits. So the first question, ladies, and I'll start with you, Jane, is can you give us your quick elevator pitch in a minute or so of what Mirabel does?
Sure. So the Mirabel Foundation is the only organisation in Australia that specifically cares for children whose parents have orphaned or abandoned them through illicit drug use, and they now live in kinship care. So a typical Mirabel family will be a grandparent caring for their grandchildren. Our mission is to break the cycle of drug addiction and to restore a child's sense of hope and belonging, and to give them some sort of normal childhood. We believe that by keeping children with their extended families, they have the greatest chance of breaking that cycle. Being investors, there's some great statistics for you. Social Ventures Australia recently conducted an SROI on the work that Mirabel do, and it found that there was evidence that we break the cycle of drug addiction in one generation. So clearly there is a social return for the child, but there's also an economic return for government future down the track. And the other thing that it found was that for every dollar that Mirabel has spent, there's been a $6.60 social and economic return, which is a pretty good return, I'm sure you'd all agree.
Great, thanks, Jane. And we love the fact that Mirabel have taken the initiative to actually, you know, discover what that measurable impact is as well. So thank you. And Bridie, can you tell us a little bit about Black Dog Institute, please?
So I'm Bridie, and I'm a research fellow at the Black Dog Institute. The institute's based here in Sydney, and we're a medical research institute, and we focus on the treatment, identification, early intervention and prevention of mental illness, and in particular suicide. And so we know that suicide is the leading cause of death in Australia, and we know that depression causes the most years lost to disability. So it's a huge economic and social burden. And at the Institute, we have a particular focus on technology, because we know that Australia is vastly rural and large population of people who are unable to access mental health care. And so we use really innovative new technology such as smartphones and the internet to design evidence-based mental health care. And a particularly unique factor about the Institute is that we operate on a translational model. So within the Institute we have clinics, research and education, which allows us that the new findings that we come across in our research, we can implement them into practice and out into the community very quickly. And therefore we have a really strong focus on evidence-based care.
Great, thanks so much, Bridie. So next question, ladies, is can you tell us a little bit about how the FGG funding is being spent? You know, approximate dollar numbers, but importantly, where the money's going and the impact.
Well, the dollars have increased over the last 3 years for us, and I think we've got about 216,000 coming to us this year. We are fortunate in that the model that FGX has allows us to be broad in the way that we use our money, in terms of we can address issues as they arise immediately and care for our families. Often with non-profits you have to apply for a specific program of funding, but FGX gives us diversity. So the money goes towards initial needs assessment, educational support, sorry, I'm just having a mental blank, but so tutors,
Therapists, that sort of thing?
Sorry, therapeutic groups for the children, initial early childhood risk assessment, yeah.
Great,
Thanks.
fantastic. And Bridie, how about with Black Dog?
So at the Institute, the money was used specifically to fund a Centre of Research Excellence. And basically what this means is a group of researchers that are focused on one particular social issue. And for us, that's youth suicide. So we use that money to band together collaborative researchers and actually fund 3 individual projects. And one of the first projects is using a mobile phone to deliver therapy specifically for people living with suicidal thoughts. And that's a little bit different to people who live with depression or anxiety. We also have another mobile phone app that uses Bluetooth technology to actually censor when you're in connection with other people, because we know that social withdrawal is a key risk factor for suicide. And lastly, we're using the money to fund workforce development. So we're investing in early career researchers like myself, in that we become very specialised in youth mental health, and it gives a sustainable future in this area.
Thank you. Thanks very much, ladies. Really appreciate you sharing that, and it really rounds out the discussion because you're very much hearing from both sides. So, thank you.